Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 US Market Update. Been some really interesting things that have occurred since the last recording. So without further ado, let's just get to the charts. I didn't want to waste any time in the intro because there's something to show you in each of the charts that we've been looking at over the last several months, starting with the chart of the SPY. And you can see the completed zigzag pattern here that we've been watching for so long with the A impulse, the B correction, and then that C extension, which did, as expected, go all the way to that 161.8% level once we tested this 78.6% fib level. So I don't want to rehash all that. All that's in the past recordings. If you're new to this recording, go back and watch those and you'll see what we've been talking about again over the last several months. So look what's happened as we hit this 161.8% extension. That's why you hear me talk about these fib levels so often. Fibonacci ratios as support and resistance. Look, it's just like bumping its head right against that 161.8% level for the past 5 days in a row. And then finally on Friday, we started to move to the downside. And we actually have an outside day on Friday. And what that means is the high of the day exceeded the day of Thursday, the previous day, and the low of the day exceeded the low. So both the high and the low are outside of the previous day's bar is what an outside day means. And that usually is a change of direction type of a thing, at least temporarily. It doesn't necessarily mean a whole trend is changing, but could be a correction. And our first Fibonacci level, which we have to respect, talked about this as well with the 78.6% fib level, which is not typically a very strong fib level, holding for the extension run to the 161.8%. We have to be prepared that fall only to the 138.2% level may be the only correction that we get. But let's take a look at the other charts and see what they're showing us as far as where we may go. So looking at TBT, this is interesting. This wave 4, we've been talking about the sweet spot. The dollar's been in a sweet spot, interest rates have been in a sweet spot, and that's allowed the market to continue higher and make that extended run all the way up to complete that C wave. But now the wave 4 here has broken down. This means it's unqualified or disqualified according to Elliott Wave rules. The fact that the wave 4 is now 74% corrective level. So a disqualified wave by Elliott Wave rules means that you retrace the previous impulse. So we should come down here now and test these lows of interest rates. Now, when we were talking about the sweet spot, you don't want interest rates to get too low. You like having low rates because that's basically the free money, the liquidity that you've been hearing about in the market, but you don't want them to get too low because then that starts to foretell economic weakness, and that's why a little bit low is okay, too low is not good, and you may wonder why. Well, that's the reason why. If we go too low, then it's showing that there's some economic weakness ahead. Now, the interesting thing here about the dollar is the dollar violated its wave 4. That's become disqualified as well on the downward Elliott wave pattern, meaning that this one is likely to go up and retrace the downward because that was an Elliott wave pattern to the downside. So the correction of that or retracing that impulse means we move up. So we're going to have interest rates going down a little lower than maybe what we like. We got the dollar going up. It's going to start to get a little bit frothy if it comes up and retraces that move to that wave 5 high that occurred back in September. So you're starting to see some pieces here come together for the correction. We've all been looking for a correction, but the question is, how big is the correction going to be, right? Well, when we take a look at the VIX, and we have this big, huge descending triangle in the VIX. All right, clearly support there at 12, pretty easy to see, and then also easy to see the level of lower highs in the VIX, and this works just like it would in any equity pattern. The VIX as far as the technical patterns. Now, the key here is that you look on Friday's move and you might think, wow, okay, we had a big move in volatility. Well, it was a bounce up in volatility, but the high of that bar on Friday did not exceed the high of this bar back on the 6th of January. So technically, you could still make an argue that we're in a pattern of lower highs on the VIX and still within the descending triangle. But if we do break this high, that 6th of January high in the VIX, well, now you're saying that we're breaking out of the descending triangle. So lots of things to consider. And then we have the black swan out there, which is that coronavirus which when it first came out, there were medical experts on there saying that even Dr. Oz was on CNBC saying that they didn't think this was the big one, that this one would be contained. But since then, it's gotten worse faster than what a lot of people thought. And some people were thinking that that's the reason that the market went down on Friday. I've been saying that I thought the traders would use the first opportunity to sell and book the gains. They've just been itching to do it with this whole run all the way up here. And maybe that's what's giving them excuse, because there is a little bit of uncertainty. You don't know how big or how widespread that could get. Could it be contained and then it kind of fades away from the news, or could it get progressively worse and actually become something that creates economic chaos because nobody wants to travel or do anything, commerce stops, etc. So there's a lot of things to consider as far as where we go from here. Is this all we're going to do? Are we just going to come down to this 138.2% level? What do things look like a little bit further out? Well, I'm glad you asked. I'd like to invite you to a free webinar on Tuesday. You can see the slide on your screen. If you've been following along with these recordings over the past couple of years, you know they're a little bit more shorter term in nature. But in this special event, we're going to use Elliott Wave analysis to take a look at the roadmap on both a medium and long term for where the market's likely to go in 2020. The event will be recorded and available to all registrants. So if you aren't able to make the live event, no worries, you'll be able to access the recording. So I hope you'll join us on Tuesday evening. I promise it'll be very informative. Thanks for your attention. Look forward to talking to you again very soon. Take care, everybody.